Good day, everyone. You are welcome to this week's Business and Investment Tips program, a production of Christ Church Radio. My name is Ayodeji Ebo, an investment professional. This week, the focus is on the implication of global interest rate hikes on investments and the Nigerian economy. In recent months, developed economies have begun to wind down the quantitative easing, which is the injection of money into the economy, measures employed to accelerate economic recovery due to the impact of the COVID-19. These and other measures are taken by governments to support the economy amidst COVID-19 are believed to be partly responsible for the current elevated inflation in developed economies. As a result, central banks have begun to raise interest rates to tame inflation. Last week, the U.S. Federal Reserve, U.S. Fed, which is the central bank of the U.S. responsible for setting the key interest rate, raised the federal funds target rate to 0.25% to 0.50% from the current 0.0% to 0.25% range, representing a 0.25% increase. This is the first rate hike since 2018, as inflation in the U.S. hit a 40-year high of 7.9% in February, well above the central bank's target of 2%. The federal fund rate is the rate at which U.S. banks borrow and lend funds overnight, that is, at the end of the trading day to meet their reserve requirements. Typically, a rate hike is used to tame inflation by slowing the growth in consumer spending, therefore forcing consumers to save rather than spend. This, however, tends to slow economic growth. Similarly, the Bank of England, the apex bank in the UK, raised interest rate from 0.5% to 0.75% last week, the third consecutive increase since December 2021. Implications for investments and the Nigerian economy. 1. Foreign portfolio investments. This refers to inflows from foreign investors who purchase securities and other financial assets in the country. According to the National Bureau of Statistics, FPIs brought in a total of $1.4 billion in the first 3 quarters of 2021, down from $5 billion recorded in the same period in 2019, showing a massive 70% drop. We could see a reversal, although this is not expected to be disruptive, given the low level of existing FPIs. Similarly, this would delay the inflow of foreign capital into the country due to the attractive interest rates on fixed income instruments in developed markets. 2. Foreign exchange rate. The reversal of foreign portfolio investments and the weak prospect for inflows into the country will constrain dollar supply locally. While FPI flows are short-term, it provides constant FX liquidity for the CBN beyond inflow from oil proceeds and Eurobonds. This may necessitate a currency adjustment in the near term, given current weak exports, which has reduced FX inflows to the CBN. 3. Government borrowings. Higher global interest rates will lead to higher borrowing costs. This implies that the government may have to issue new Eurobonds at higher interest rates, increasing the cost of borrowings. This may result in the government borrowing more within the country. We may experience slight sell-offs in existing Eurobond, leading to higher interest rates. This is positive for new investors based on the higher return. 4. Fixed income rates. With the anticipated increase in borrowing domestically, we expect interest rate on fixed income instruments to increase in the second half of the year. This presents good investment opportunities for investors and reduces the impact of inflation on your investment. This will also improve the return on fixed income mutual funds. We do not anticipate any major sell-offs by FPI due to their limited participation in recent times. 5. Foreign stocks. Since December, the anticipated rate hikes have depressed global stock market performance. This presents great opportunities for long-term investors to buy into good companies at low prices. Investors can also rotate into the financial services sector as companies within this space benefit more from rising interest rates. Investment in foreign stocks also provide a good edge against naira devaluation and rising inflationary pressures. 6. Nigerian stocks. Foreign investors control just 12.8% of the Nigerian stock market activities as of January 2022, compared to 87.2% held by domestic investors. As a result, we do not anticipate any major sell-offs that would dampen the market significantly. The downside risks for the Nigerian stock market remain the upcoming election, as well as the expected rise in interest rates. This will reduce domestic participation in the stock market. However, this presents long-term investment opportunities in good companies. We expect more interest rate hikes across the developed markets this year. Thank you for listening. Please join us same time next week for another exciting and interesting session. For questions, comments, and feedback, kindly forward to getfinanceandinvestmenttips@gmail.com or send SMS to 070-8246-3747. Stay blessed.